Investing is not an easy task. Or well, actually, we make investing hard because we could just choose to buy an index fund, wait for 30 years, and then take our cash out and be extremely wealthy. However, some of us prefer to own companies because maybe we believe that we can beat the market, or because maybe some of us actually enjoy doing that process. Regardless, we're constantly looking for ways to improve our ways of investing and our strategy. Perhaps the greatest quote by the greatest investor of all time is this one: "Be fearful when others are greedy, and greedy only when others are fearful." This is a great rule that we must follow if we want to be successful in the stock market, especially if we're stock picking. However, today we'll be looking at 8 other golden rules that you should follow if you want to become better at investing. Starting with number 1. Only invest in what you understand. Now, this is a theory that was mainly popularized by Peter Lynch in his book One Up on Wall Street. He calls it having an edge. An edge is something that you know, and you know much better than anyone else. We all have passions, we work in different industries, we have different relationships, different backgrounds, which causes each one of us to know a lot about different things. For example, I'm a sports enthusiast. I've been doing sports all my life. I follow everything related to sports, I watch, I buy, and I know the different trends in the industry. So clearly, one of my edges would be in the sports industry. And this can actually provide you with a lot of valuable experience, because I would have probably been seeing already that I wasn't liking Nike as much anymore, that I was preferring Adidas, or that Puma was becoming a more attractive brand year after year after year. And when you apply this edge in the stock market, it can actually make you a lot of money, if you know how to use it. Peter Lynch states that in order to outperform experts, we should identify our edge and use it to our advantage. It doesn't make sense that someone like me, who knows nothing about semiconductors, is looking to invest in Nvidia, ASML, Intel, AMD, or anything like that, unless it's an opportunity that hits you head over heels. It makes a lot more sense that I take my valuable time and I invest it in something that I know very well. This can help you define a better investment strategy, select better investment opportunities, and in case things go south, you can understand when to jump out or when to keep holding the company because it's only a small bump in the road. The second most important rule is to never invest in poor quality businesses. There are a lot of times where you will be seduced by everyone on YouTube talking about a specific stock, that stock having a price to earnings ratio of maybe 5 to 6 times earnings, you believing that it's a great opportunity because everyone else is talking about it. But the thing is that in a lot of these cases, we're actually seduced to go and buy a bad business. Why are these so attractive? Well, this is because we're attracted to turnaround plays, meaning companies that are doing very poorly, but we believe that they can turn around, and if they do, we will make a lot of money. Well, I don't believe you should invest in these businesses. And just as an example, we can see over here WCA, which created 2 different indices, one which contains high quality companies and another one which contains low quality companies. Now this is very interesting. In terms of annualized returns, the low quality index actually outperformed the high quality index. But when we look at the total risk, which is the volatility that the companies have gone through throughout the same time period, we can see that the low quality index is way riskier than the high quality index. So when we turn this into risk-adjusted returns, we can see that the high-quality index clearly outperforms the low-quality index, and this is something very important to keep in mind. In that same study, WCA took the 100 companies in the S&P 500 which had the lowest PE ratio, and categorized these companies based on their quality. And what they found is that the majority of these companies were actually extremely poor quality, with only 4 of these companies having an A quality, and more than half of these companies actually having a D or an F quality. So, as Warren Buffett states, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, rule number 3 is don't focus too much on valuation. And I know this is easier said than done because I still have trouble with this one, but I will show you a study which actually supports this. Over here we can see the annualized returns for the different decades and how it splits between 3 different variables. These variables are dividends, earnings growth, or price to earnings change. We can see that depending on the year it changes, but if we take the average and we look at the 2010s, which is the closest decade to us, we can see that earnings growth is the clear leader of performance in the S&P 500. So this basically means that when we're buying companies, Yes, of course, we should take a quick look at the valuation to see if the company is trading at a reasonable price level or not. However, we should not become obsessed with this, because in a lot of these cases, we can actually miss the chance to buy an amazing company. For example, imagine you were interested in Palantir last year, and you noticed the stock right where the graph says. However, since you decided to buy it at that valuation because it's the one that you set for yourself, you actually missed the boat, because the day you wanted to buy the company, it shot up around 10-15%. So you decide to wait. The stock market is a volatile place. I will for sure get an entry price in the following months. And for a couple of months, it looks that way. However, Palantir never actually dropped back down to those levels, and instead rose an incredible 140% in 1 year. This is a very extreme case, but believe me, this has happened to me a lot of times. I believe it's something that we have in our nature, and it's very hard to get rid of it. But the way that I'm trying to actually get around this is by making a rule for myself, where if the company has a free cash flow yield of above 3%, it should be a buy regardless of the price to earnings ratio. As Peter Lynch says, far more money has been lost by investors trying to anticipate corrections than has been lost in the corrections themselves. Rule number 4 is extremely correlated to the previous one, which is do not try to time the market. Over here we can see the cost of timing the stock market in a very visual representation. It takes an example of you investing $10,000 in the stock market on the 1st of January of 2003, and it estimates the returns that you would have had on December 2022, depending on how many days you missed of investing. So if you invested for the full duration for the full 20 years, you would have around $65,000 at the end of the time period. Not bad at all. However, if you missed just the 10 best days, your final balance would be less than half. Now this keeps decreasing, but the thing is that once you've missed the 40 best days of the stock market in a 20-year period, your return would have actually been negative. So as Charlie Munger says, the big money is not in the buying and selling, but in the waiting. Rule number 5 is one that is not spoken about enough, but is basically to not over-diversify your portfolio. There is a very widespread theory that your portfolio should be diversified, containing stocks from different sectors, from different sizes, different geographies, because in the case that there is a market shock, for example with the new tariffs that the US just introduced, well, they will help reduce the impact that these shocks have over your overall portfolio. However, there is such thing as over-diversification, where imagine you're so diversified that if one of your stocks has returned a 100%, since your portfolio is so large and your positions are so small, then that only translates into a 5% portfolio increase, meaning that by over-diversifying, you're actually worse off and you're harming your best positions. This graph over here shows that the returns on the S&P 500 are highly skewed. We can see that more than 30% of the companies in the S&P 500 between 1999 and 2019 actually had a negative return. So there is a 1 in 3 chance that you will lose money depending on which stocks you pick. Now those of you who are big into stock picking and have already developed a clear strategy already know that finding a good stock to start a position on and to include into your portfolio is extremely difficult. There are not that many amazing companies that fit into our portfolio and into our strategy as good as the ones that you can find once in a while. So imagine that you now have to include over 50 stocks into your portfolio in order to be diversified. Well, first of all, that will actually reduce the quality of the companies that you're purchasing. It will make it a lot more likely that they don't follow the strategy that you want to follow, and you will increase the probability of you actually purchasing one of these stocks, which will have a negative return over the next years. The key here is to choose stocks that you're comfortable with, that you believe that are great investments, and that at best have very different types of market behavior. Because, as Peter Bernstein says, a few holdings with radically different types of market behavior will do more to smooth out the pattern of portfolio returns than 50 or 100 holdings that move up and down together. Now, rule number 6 is to not engage in the greater fool theory. But what is the greater fool theory though? Well, this is the theory that a lot of investors actually purchase securities above their fair value with hopes of selling them at a more expensive price just because of different market circumstances. We have seen this a lot of different times throughout history. One of the most recent examples can be with any type of cryptocurrency, where if you're a believer, you can say that Bitcoin has a fair value, and that this value increases every time that it's used in heavy transactions, every time that they lower the fees, every time that they're able to process transactions in a quicker, more efficient way, and of course, every time that there is a halving, because that reduces the supply, which inherently increases the value of the asset. However, there has been a long time period of heavy speculation where it seems like everyone was getting into cryptocurrencies in hopes to sell it in a couple of weeks to someone at a way higher price, without a sense of intrinsic value or without a sense of fair valuation. And this actually happened in the latest financial crisis of 2007, where everyone was buying houses because the price was just going up and kept going up and kept going up, and there was no sense of fair value or intrinsic value whatsoever. There was just a sense of you will buy, the price will never fall, and there will be a greater fool in the short-term period who will buy the house from you at a way higher price. Of course, this can work for a couple of years. However, there is always a time when there is no other greater fool at the top, and it all just comes crashing down. So your objective should not be to buy only to sell it to someone at a higher price. Your objective must have a clearly defined strategy, which moves us to the next point. You should commit to a plan or a buy thesis. There are many reasons to buy stocks, and there are many reasons to sell. One thing that helps me commit to a plan or investment strategy and actually not sell and get emotional during tough times is to write my investment thesis down. For example, I may buy a company and I'm planning to sell it under different circumstances. Maybe it's a company that I love and I know that it will be here forever, so then I will hold it until retirement. Or maybe I just bought a growth stock and I will hold it until the growth rate is lower than 15%. The important thing is to create a plan and a strategy. If not, you will get scared out and you will not have a purpose for that investment. And as Charlie Munger mentions, a lot of success in life and business comes from knowing what you want to avoid. And last but not least, I believe this is the jewel in the crown, the most important rule of investing is that you should disregard short-term fluctuations. And just to put it in a very simple manner, we've already discussed that the longer you hold onto a stock, the more likely you are to actually make a positive return on that company. However, just in case that example has not stayed with you, we can take a comparison of the S&P 500 price evolution for the last 2 months and the last 30 years. Often we're carried away by the volatility of the market. We can see that even the S&P 500, which holds the largest American companies, which in theory should have stable valuations, well, look how volatile this is. It goes up a couple of percentage points or more every single week, and we base a lot of our decisions and a lot of our emotions on this. However, if we zoom out and we take a longer time period, that short-term volatility, those 2 to 3 percentage points mean absolutely nothing. In a 30-year time period, the only thing that matters is that you bought and that you held. It does not matter that you bought at a better price than the rest, because at the end of the day, the one who held for the longest time will be the one who will have a better return over time. And that 2-month period, well, you can't even see it on the graph. And the problem is that we base a lot of our decisions on that 2-month time frame, on that volatility that at the end of the day will not matter and will not affect our stock performance, unless we allow it to. I have had a lot of times where that short-term volatility has scared me away from positions, which I have then regretted not getting into at that time. And yes, this is the hardest thing to master, but I believe that once this is mastered, it is the key that unlocks the ability to become a great investor. So anyways, I hope you enjoyed this video. Thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.